What are you taking in terms of signals from the behavior of these yield curves?
So the behavior of the yield curves, plural, certainly deserves really close attention from Fed policymakers and investors. And I'm certainly not going to ignore any of these signals. But I will tell you that here's another yield curve that I look at, the real yield curve. If you compare the real 2-year with the real 10-year, the real 2-year yield is still way below the real 10-year yield. And that's giving me a bit more confidence that a recession is not right around the corner.
So that's, you think, the most important message for investors here?
I think the larger message is that, we want to look at multiple different versions of the yield curve. Don't get fixated on one single metric like the 2s, 10s. Look at the 3-month to the 10. You're exactly right to flag that one up, telling a different story. Look at the real 2s to 10s against the nominal 2s to 10s. You create a picture, a better picture, by looking at all these indicators. They are, some of them, starting to flash a warning sign. When you look across the board at this range of metrics, I would say there is overall not a signal of imminent recession risk here.
And I think we should clarify that there's two different camps about recession. There's the camp who thinks the economy is weak now, the tightening is a mistake, and that's how we're going to get into a recession. I'd call it, if you want, the Dave Rosenberg camp. There's also the camp, this is what Bill Dudley's warning is about, Larry Summers and many others, who say the Fed is so far behind the curve, they're going to have to tighten so much in the future that will guarantee a recession. So two very different, one dovish, one hawkish approach to the recession risk right now.
100%, 100%. The timeline is, I think, quite different with those two stories, right? In the Rosenberg type story, the economy must, I think, roll over this year, right, as the Fed starts to kick in these hikes in the QT. In the Dudley Summers type story, and there are some nuances between different versions of this story, I think, if I understand it right, the recession risk is more next year, right, when the Fed gets to say 3% on Fed funds, finds that's not enough, has to keep on going, maybe even gets as far as 4 or something like that. And then every single yield curve inverts, economy slows really brutally, and we get a full-bore recession.
So the bad news about the sort of dovish, the Rosenberg camp, is that they would say the Fed needs to back off. The good news about the Summers, Dudley, if you want to call it that camp, is there's an implication that they can still save us from a recession if they're aggressive enough right now. And that brings us to your call for hikes. 3 half-point hikes possibly at this point. Could that do enough to catch up with the neutral rate to keep us from that problem next year, from a downturn?
So I still think that it is plausible we could pull off a soft-ish landing, but it's going to require the Fed to be very nimble and to thread what is not, a pretty tight needle here. So what's our call on the Fed, right? 3 key ideas here summed up in the phrase, up hard, then down again. So what does this mean? First, we think the Fed is embracing the idea of more of a front-loaded level shift back towards a neutral rate this year, delivered via several 50s. Exactly how many? Hard to pin down. Our base case is 2 or 3, probably with the first 50 coming in May. So with 2 or 3 high 50s and quarter points at the rest of the meetings this year, you're looking at the funds rate around 2.5 at the end of the year. I think the Fed would view that as a neutral-ish setting looking forward. Then, second leg, we see the Fed pushing on into the low mid 3s in the first half of next year, trying to overhaul that core inflation rate, get real rates positive, and then over time apply a little bit of restraint. But then, third leg to our call, we think that the market and the macro data is going to tell the Fed the economy can't really handle a 3.5 type Fed funds rate for any extended period of time. We think we will get a proper recession scare. And if the Fed is quick enough, they will then pull off what they did in 2018-19. They will cut rates 3 times in our base case, early 24, maybe late 23, come back down to a funds rate in the 2.25%, 2.5% range. And that's something the economy, we think, can sustain and potentially extend the business cycle. So we can see the possibility of achieving a soft landing here. But boy, it's going to be hard to get that exactly right.
Shepard Smith here. Thanks for watching CNBC on YouTube.